Yesterday, President Trump addressed last week's stock market turmoil, which was triggered by confusion over his tariff agenda. It's now becoming evident that the tariff hikes will be much larger than anticipated, and the same might apply to the broader economy. According to Trump, the administration inherited a severely damaged economy. In a surprising move that breaks decades of silent financial cooperation, Japan, America's long-standing financial ally, executed an unprecedented $1.7 trillion sell-off of U.S. Treasury bonds. This decision is poised to reshape the financial landscape. For years, Japan's investments in U.S. debt supported the dollar and enabled Washington's heavy spending. But with Tokyo abruptly cutting off this lifeline, Wall Street spiraled into chaos. Bond yields surged, the dollar wavered, and global markets sank into instability. Amid the turbulence, one critical question emerged. Why would Japan, a cornerstone of America's financial dominance, choose to break this historic trust? The answer appears rooted in Washington's overwhelming political overconfidence. And this is only the beginning. Stay with us as we explore how this dramatic shift could redefine your financial future and shake the foundations of the global economy. The day Washington lost control began with a move meant to protect the U.S. economy, but ended up accelerating its decline. It all started with a policy wrapped in patriotic rhetoric, yet fueled by protectionist motives. Under President Donald Trump, the U.S. government imposed heavy tariffs on imported electric vehicles, targeting Japanese automakers like Toyota, Honda, and Nissan. The intention was straightforward: shield domestic giants such as Tesla, General Motors, and Ford from growing foreign competition. But what Washington underestimated was the depth of the blow it delivered. For decades, Japan has led the charge in hybrid and electric vehicle innovation. Toyota revolutionized the industry with the Prius, and Nissan brought EVs to everyday consumers with the Leaf. This wasn't just about business for Japan. It was about national pride, technological leadership, and economic identity. The tariffs struck a nerve. To Tokyo, it felt like a betrayal of a long-standing alliance, a rejection of decades of collaboration. Negotiations quickly fell apart. Private meetings ended in stalemates. Instead of backing down, Washington doubled down, pushing Japan's most iconic industries into a corner. But Japan had a weapon that America failed to consider. It wasn't steel or automobiles. It was capital. The choice to unload $1.7 trillion in U.S. Treasury bonds wasn't made in haste. It was a calculated act of financial retaliation. Without firing a shot, Japan targeted the very core of America's economic engine. The message was clear: attack our industries, and we'll hit your economy. This massive bond sell-off wasn't a simple reaction. It was a deliberate escalation, and the shockwaves hit fast. Wall Street felt the tremors immediately. Treasury yields spiked as bond prices plummeted. Confidence evaporated. Hedge funds dumped stocks. Institutional investors scrambled. Foreign governments began questioning whether they too should start pulling out of U.S. debt. And in just 3 weeks, $5 trillion in market value disappeared. The American stock market nosedived. Blue-chip companies lost billions in value. Pension funds faced devastating hits. Millions of everyday investors watched their savings shrink overnight. All of it traced back to one decision, one tariff, one miscalculation that turned an economic shield into a self-inflicted wound. Ordinary Americans watched in disbelief as their retirement accounts shrank overnight. The financial media scrambled to offer explanations. Some called it a market correction. Others blamed global uncertainty. But anyone truly paying attention knew better. This wasn't a natural market shift. It was Japan quietly pulling the pin on a financial grenade that had been lodged in America's pocket for decades. While Wall Street absorbed the initial blast, the real pain was just beginning to ripple out to Main Street. True casualties of this economic fallout weren't sitting in Washington boardrooms or Tokyo high-rises. They were in living rooms across America. As the dust settled from the bond sell-off and market crash, its impact started to seep into the everyday lives of regular people. For families already grappling with inflation, the aftermath hit like a punch to the gut. The weakening dollar drove prices higher across the board. Imported goods became more expensive, and staples like groceries and gasoline climbed to unaffordable levels. Tariffs on Japanese electric vehicles, combined with the collapsing value of the dollar, sent car prices soaring. For many Americans, the hope of buying a new electric vehicle became a distant dream. And it didn't stop there. As Treasury yield shot up, so did mortgage rates. First-time homebuyers were pushed out of the housing market entirely, while those with adjustable-rate mortgages saw their monthly payments explode. Credit card interest rates surged, draining already strained household budgets. Meanwhile, wages stayed flat. The average American worker found their paycheck covering less and less each month. Savings dried up, retirement plans unraveled, and at the center of it all was one decision: a move to spark an economic conflict without considering the fallout for those least able to withstand it. But the middle class's suffering was only one chapter in this unfolding crisis. As financials, pressure mounted at home. Something far more dangerous was building, in the corridors of global power and the restless streets of America. What began as a retaliatory strike from Japan was rapidly turning into a broader uprising. Tokyo's decision didn't just send Wall Street into chaos, it sent a message to the world. By selling off hundreds of billions in U.S. Treasury bonds, Japan wasn't simply reacting to tariffs. It was leading a revolt, signaling to other nations that the time had come to challenge America's financial supremacy. A global anti-dollar rebellion was brewing, and Washington had no idea what was coming next. For decades, Japan had been the most dependable financier of U.S. debt, consistently purchasing treasury bonds that helped sustain the American economy. Washington had long assumed that Tokyo would always play by its rules. But now, that assumption was shattered. Behind closed doors, Japan's leadership had stopped asking how to preserve their alliance with the United States and started asking how to survive without it. The Treasury bond sell-off was just the opening move. Japanese financial leaders began quietly coordinating with other major economies that shared the same frustration. The dollar's iron grip on global finance. China had already begun reducing its dollar reserves. Russia, under the weight of sanctions, had long divested from American assets. Countries like South Korea, India, and several smaller Southeast Asian economies were slowly shifting their financial strategies. But none of these nations carried the financial credibility that Japan did. When Tokyo acted, it gave these countries the cover they needed, a respected economic heavyweight making the first move, legitimizing what others had only whispered about. Together, they began laying the foundation for something more radical than a trade war. A global push to abandon the dollar. What followed exposed the full extent of Japan's shift and who stood to gain. While U.S. media focused on tariffs and market crashes, Tokyo was quietly redirecting its financial might into Asia, reshaping the landscape of global finance. For decades, Japanese capital had supported the U.S. economy, propping up the dollar, stabilizing markets, and keeping borrowing costs low. But after years of being treated as a subordinate in the U.S.-dominated system, Japan was done. The sell-off of U.S. bonds was part of a broader pivot, a strategic reallocation of capital aimed at building a regional financial network independent of the dollar. Billions began flowing into Southeast Asian markets. Japan increased its bond purchases from China, South Korea, and India. It poured money into Asian development funds, expanded currency swap agreements, and enabled more trade in local currencies, bypassing the need for dollar-backed transactions. This was no longer just retaliation. It was economic reinvention. China quickly embraced the shift. Beijing had spent years pushing for a dollar alternative, but without Tokyo's backing, those efforts lacked legitimacy. Now, with Japan on board, the vision had real momentum. South Korea, India, and countries like Vietnam, Indonesia, and Malaysia joined the movement. Quiet summits were held, policies drafted, and deals signed, all out of sight of American eyes. While U.S. financial institutions scrambled to manage the immediate fallout, falling bond prices, volatile markets, evaporating investor confidence, they failed to see that the ground beneath the dollar was eroding. And how did Washington miss it? The answer lay in its own hubris. U.S. policymakers believed Japan would never turn its back on them. They clung to the belief that economic dependence guaranteed loyalty. They pointed to the post-war alliance, shared military commitments, and trade ties. They thought that no matter how many tariffs they imposed, or how often they weaponized the financial system, Japan would simply endure. That assumption was fatal. It blinded Washington to the growing resentment in Tokyo. Japan had watched for years as the U.S. slapped tariffs on its auto industry, blocked its tech exports, and sidelined it in major trade deals. It had tolerated decades of dollar dominance, while wrestling with its own economic stagnation. And every time it tried to push back, it was told to fall in line. The final insult came with the electric vehicle tariffs, an attack not just on an industry, but on Japan's pride, its innovation, and its identity. That was the breaking point. And from that moment on, Japan stopped playing by America's rules and started writing new ones. Japan's proudest industry, its technology and automotive leadership, was no longer seen by Washington as an asset, but a threat. That shift in perception crossed a line Tokyo had warned about for years in private diplomatic channels. When Japan began selling off U.S. Treasury bonds, American officials brushed it off as a temporary protest, a momentary flare-up of discontent. They completely underestimated the depth of the resentment. They failed to recognize that Japan no longer believed in the old unspoken agreement of financial loyalty. U.S. leaders assumed the system was too big to fail, too powerful to challenge. They were wrong. And as Japan quietly walked away, other nations watched and prepared to follow. Then the dominoes began to fall. Japan's move was just the beginning. As the world's third-largest economy publicly defied the dollar's dominance, it opened the floodgates. South Korea began reducing its U.S. Treasury holdings, citing growing concern over market volatility and exposure. India accelerated its diversification strategy, shifting investments away from dollar-denominated assets and boosting its gold reserves. Taiwan discreetly reallocated parts of its sovereign wealth funds into regional bonds. These weren't symbolic moves, they were tectonic shifts in global finance. For the first time in decades, the idea of a global financial system not anchored by the dollar became not just imaginable, but real. This wasn't driven solely by economics. It was fueled by distrust. Years of trade wars, sanctions, and the weaponization of the dollar had pushed even America's allies to question their reliance on Washington. The Trump administration's aggressive economic policies made the world's leading economies feel less like partners and more like pawns. The frustration spread far beyond Asia. In Latin America, governments began holding talks on regional currency alliances. Oil-rich nations in the Middle East quietly explored non-dollar trading frameworks. The European Union, already weary from escalating trade tensions with the U.S., reopened discussions on launching a digital euro to facilitate global trade independent of the dollar. The dollar wasn't being attacked by enemies. It was being abandoned by former allies. And as Washington scrambled to manage the growing financial chaos, it failed to grasp the bigger threat. Because the most devastating blow wasn't just economic anymore, it was political. Then came President Trump's full-blown economic war against Japan. The moment Tokyo dumped $1.7 trillion in U.S. Treasury bonds, Washington struck back with brute force. Diplomacy was off the table. Instead, the Trump administration launched the most aggressive economic retaliation against Japan in modern history. In one sweeping move, maximum tariffs were imposed on nearly all Japanese imports, everything from automobiles and electronics to household goods and industrial equipment. Tariffs soared as high as 100%, instantly dismantling decades of economic cooperation between the two nations. The White House framed the move as a necessary defense of American jobs, portraying Japan's bond sell-off as an act of economic aggression. But the rhetoric turned even more dangerous when Trump threatened sanctions against Japanese banks, accusing them of destabilizing the U.S. financial system. For Japanese automakers like Toyota, Nissan, and Honda, already staggered by the earlier electric vehicle tariffs, this was an existential blow. Their future in the U.S. market now hung by a thread. Tokyo's response was icy and precise. Japanese officials condemned the tariffs as reckless economic aggression and vowed to accelerate the process of financial decoupling. The message was clear. Japan was done playing by America's rules. And now they weren't just walking away from the table. They were flipping it over. Japanese investors quietly began pulling their money out of Wall Street, signaling a deepening rift. At the same time, Tokyo initiated financial coordination talks with Beijing and Seoul, setting the stage for a regional economic alliance. What had begun as a retaliatory move against tariffs had now escalated into a full-blown economic war. But President Trump wasn't finished. The fire he sparked in the Pacific quickly jumped the ocean. Just days after imposing massive tariffs on Japanese goods, Trump turned his attention to Europe. Without warning, the administration announced a staggering 200% tariff on French, Italian, and Spanish wines, champagnes, and other alcoholic beverages. European leaders were blindsided. The White House defended the decision by citing European Union tariffs on American steel and aluminum, calling them discriminatory and unjust. The fallout was swift and severe. Wine producers in Bordeaux, Tuscany, and Catalonia warned of billions in lost revenue. European headlines accused Trump of using trade as a weapon, calling it economic blackmail. Brussels wasted no time in hitting back. The EU retaliated with its own set of tariffs targeting American agriculture, luxury goods, and tech exports. On both sides of the Atlantic, industries were caught in the crossfire. French vintners, Italian winemakers, American soybean farmers, and Kentucky bourbon distillers all found themselves suffering from a trade war they had no part in starting. The timing couldn't have been worse, with the global economy already reeling from Japan's bond sell-off. Wall Street hemorrhaging trillions, and inflation climbing. The last thing the world needed was a transatlantic trade war. Yet that's exactly what unfolded. As financial markets across Europe and North America buckled, it became clear that the very economic system that had underpinned global stability since World War II was starting to fracture. And while Washington tried to manage the chaos, it overlooked the quiet steps being taken just across its northern border. Even Canada, America's closest ally, decided it was time to step back. For decades, Ottawa had been one of Washington's most steadfast partners, economically, militarily, diplomatically, but amid the storm of tariffs and unpredictability, Canada began charting a new path. In a move that stunned observers, the Canadian government accelerated a series of trade and defense agreements with Australia, the European Union, and Southeast Asia. In just a few months, Canada locked in over $7 billion in combined deals. Among them was a landmark $6 billion Canadian contract for long-range radar systems from Australia, a clear step toward reducing reliance on U.S. defense infrastructure. Ottawa wasn't subtle. The message was unmistakable. Canada no longer trusted the direction of American leadership. It expanded trade deals with Europe, securing access to markets that the U.S. was now alienating through its tariff aggression. Canadian officials called these decisions a safeguard, an insurance policy against Washington's economic volatility. But this shift wasn't just about trade and defense contracts. It was the beginning of a deeper realignment. Canada, like Japan, was no longer willing to be taken for granted, and as more allies began to re-evaluate their positions, the United States faced a sobering truth. It was no longer the unchallenged center of the global economic order. They marched. From the rusting steel mills of Pennsylvania to the empty auto plants of Michigan, workers organized like never before. But this wasn't a protest in the traditional sense. It was an uprising. One born from betrayal, fueled by desperation, and united across political lines. Union halls that had once fought each other over contracts began coordinating. Non-union workers joined in, forming grassroots coalitions that crossed industries and state lines. It was no longer about one company or one sector. It was about a generation of Americans demanding answers and, more importantly, demanding change. They shut down highways with caravans of trucks. They surrounded state capitals with crowds waving signs that read, "Where's our recovery?" and "Tariffs took my job." Social media lit up with viral footage of walkouts and sit-ins. Major ports and shipping centers saw slowdowns as labor. Unrest spilled into logistics, with dock workers and drivers refusing to unload goods tied to corporations lobbying for more tariffs. The government tried to spin it. Officials claimed the economy was stabilizing, that this was a temporary adjustment period. But no one was buying it, especially not the millions who had watched their paychecks shrink, their savings disappear, and their dreams dissolve in the heat of a war that wasn't fought with bullets, but with policies. As the movement grew, so did its demands. What began as a backlash against job losses quickly evolved into a broader call for structural reform. Workers wanted an end to tariff-driven economic nationalism. They wanted investment in renewable industries, in reskilling programs, in healthcare, and education, not bailouts for multinational corporations. Most of all, they wanted accountability. In Washington, panic began to spread. Poll numbers plummeted. Congressional hearings were called. Think tanks scrambled to produce solutions, but it was too late. The uprising had taken on a life of its own. And the pressure was mounting not just on policymakers, but on the entire system that had led to this breaking point. And while the United States grappled with this internal reckoning, the rest of the world moved on. Global financial centers rebalanced. Trade routes were redrawn. A new multipolar economic order took shape, with Japan, China, and the European Union at the center. The era of American economic supremacy was over, not with a bang, but with a tariff. The first strikes erupted in Michigan, but they spread with astonishing speed. Auto workers were the first to walk off the job, followed by steel workers, then teachers, truck drivers, and retail employees. By the time the dust settled, more than 5 million Americans were on strike, the largest labor uprising since the 1930s. Their message was clear: the White House had failed them. Union leaders laid the blame directly at President Trump's feet, accusing him of launching an economic war that sacrificed American workers in the name of power. Many who had once cheered for his tariff policies now stood on picket lines, demanding not only higher wages, but an end to the decisions that had hollowed out their towns. The media dubbed it the Great Worker Revolt, but this was more than a news cycle. It was a reckoning, a rebellion fueled by broken promises and economic betrayal. And while workers took to the streets, another betrayal was quietly unfolding in the glass towers of Wall Street. For years, the markets had tolerated Trump's chaos because profits were booming. Stocks soared, corporate wealth exploded, and the billionaire class raked in historic gains. But when Japan offloaded $1.7 trillion in U.S. bonds and global markets began to unravel, the patience of America's financial elite wore thin. Corporate donors slashed campaign funding. Hedge funds shifted money overseas. CEOs who once clinked champagne glasses with Trump at galas now privately called for new leadership. Financial media turned critical, openly questioning whether the president had become a liability to the economy. The backlash was swift. Sensing a shift, Republican lawmakers began to back away. Poll numbers cratered. The business class that had once bet big on Trump now abandoned him, leaving the administration politically stranded and economically cornered. Wall Street's betrayal wasn't loud. It came in silence. Capital flight, plunging stock indexes, and whispered warnings that American dominance was fading. And they were right. As Trump battled unrest at home and diplomatic collapse abroad, a new global system was quietly taking shape, one that no longer centered on American control. Behind closed doors, Japan, China, and Russia unveiled a joint proposal for a new financial framework, an international currency basket supported by a coalition of Asian and Eurasian powers, intended to dethrone the dollar as the world's primary reserve. It was a simple idea with massive consequences. For decades, the dollar had granted the U.S. unmatched global power, enabling endless deficits, punishing adversaries with sanctions, and anchoring global trade. But the moment Japan walked away, that privilege began to vanish. One by one, nations followed. India, Brazil, and even some European countries discreetly reduced their dollar reserves. Trade deals began referencing alternative currencies. Oil. Contracts that once defaulted to dollars were now being negotiated in yuan, rupees, and rubles. The empire America had built over 75 years wasn't collapsing in flames. It was dissolving, quietly, transaction by transaction. Washington could no longer steer the global economy. The Federal Reserve's grip on international interest rates weakened. For American consumers, the fallout hit home fast. Credit dried up, imports surged in price, and the illusion of economic invincibility disappeared. The collapse wasn't just about politics or economics. It was existential. A superpower that had ruled the financial world for 3/4 of a century suddenly found itself isolated, surrounded by old allies who had made the painful decision to to move on. And now, the world was left with one unsettling question. Without the dollar at the center, who shapes the future of the global economy? Let us know what you think in the comments. We'd love to hear your take. Thanks for watching.